In this module, we will learn principle of insurance. Insurance contracts are guided by a number of principles. The first principle is principle of utmost good faith. Principle of utmost good faith. Both the parties, the insurer and the insured, should enter into a contract in good faith. An insured should provide all the information that impacts the subject matter. For example, John took a health insurance policy. At the time of taking policy, he was a smoker and he did not disclose this fact. Later, he was diagnosed with a cancer. Insurance company had every right to dishonor his claim as he did not disclose this information. Similarly, insurance companies should also provide all the details regarding insurance contract in a transparent way. Principle of insurable interest. Insurable interest is established by ownership, possession, or direct relationship. For example, people have insurable interest in their own homes and vehicles, but not in their neighbors' houses and vehicles, and almost certainly not in those of strangers. Thus, an insured must have insurable interest on the subject matter. For example, in case of life insurance, spouse and dependents have insurable interest in the life of a person. Corporations have also insurable interest in the lives of their employees. Let us understand this with the help of an example. A cannot insure for B if B is a complete stranger. However, A can insure for B if B is either a family member like a spouse or a debtor or an employer. Principle of indemnity. Principle of indemnity means a guarantee to put the insured in the position as he was before the accident. Thus, the insured can't make any profit from the insurance contract, as insurance contract is meant for cover the losses only. Now let us understand this with the help of an example. Shyam insured his car against accidental damage with a cover of 2,50,000. Due to the accident, he suffered a loss of 1,50,000. The insurance company will compensate 1,50,000 only and not the policy amount, which is 2,50,000. As the purpose here is to compensate the loss and not to let him make profit out of it. Please note that this principle does not apply to life insurance policies. Principle of contribution. Principle of contribution means that if at the time of loss it is found that there is more than one policy covering the same loss, then all policies should pay the loss proportionately to the extent of their respective liabilities, so that the insured does not make profit by making claim for same loss more than once. For example, Raj has a property worth rupees 5 lakh. He took insurance from a company A worth rupees 3 lakh and from company B worth rupees 1 lakh. In an accident, his property damaged and he suffered a loss of rupees 3 lakh. Raj can claim rupees 3 lakh from insurance company A, but after that he cannot make profit by making another claim from insurance company B. Now, insurance company A can make a claim from insurance company B for proportional loss claim value. Principle of subrogation. Principle of subrogation is after the insured gets the claim money, the insurer steps into the shoes of insured. After settling the insured's claim, the insurer becomes the owner of the subject matter. For example, Ram took an insurance policy for his car. In an accident, his car got totally damaged. Insurer paid the full policy value to the insured. Now Ram has no right on the scrap and the insurance company can sell off the entirely damaged car and get the salvage value. Principle of proximate cause. The word proximate cause means nearest cause. An accident may happen for more than one cause. In case the property is insured for only one cause, in such a case, the nearest cause of the accident is found out. Insurer pays the claim money only if the nearest cause is insured. Now let us understand with an example. A man is riding a bike in a lonely hill place. He falls from the bike and gets injured. He remains unconscious the whole night under the exposure to severe cold. The following morning, he was discovered by some people. He contracted pneumonia and died. So here, the proximate cause of his death is the accident, that is, falling from bike, and not pneumonia. So in the principle of proximate cause, the nearest cause is taken into consideration. Principle of loss minimization. This principle states that the insured must take all the necessary steps to minimize the losses to insured assets. For example, Ram took insurance policy for his house. In a cylinder blast, his house burned. He should have called nearest fire station so that the loss could have been minimized. This is all about principle of insurance. In our next module, we will discuss insurance products in detail. Till then, stay tuned, keep learning.